Preface. Credit scores are not the easiest three numbers to understand. With just three figures telling you whether you can obtain a loan or not, or get a mortgage or not, makes credit scores one of the most important things in our lives. Especially when you depend on loans to help you fulfill your dreams of owning a house, a car, or an expensive piece of household item. So what makes credit scores what they are? How does anyone find out if you are worthy for a credit or not? Are these always right? Can a business depend on these credit scores entirely when it comes to deciding whether a client should get a credit or not? There is a lot of confusion among people about how credit scores are obtained and how they are scored. Keeping in mind that these scores can make a huge difference in your ability to buy new products, it is important that you should have complete understanding of credit scores and how they affect your buying power. Different countries calculate credit scores differently. They even utilize credit scores for different reasons. There are a number of models that help companies follow a methodology for credit scoring. People usually have a lot of questions about how to build credit and if they will ever be able to restore their credit score to make sure that they can obtain loans or mortgages without problems. Many countries allow people to get a free credit report in order to ensure that they have complete access to the details that are affecting their credit score. However, in some countries, it is treated differently, where you may have to pay for getting your credit report, which can help you identify the high and low points of your credit score. Introduction. Long before credit bureaus saw the light of the day, lenders and businesses relied on a person's past transaction history with them, word of mouth and home visits to know about their financial condition before money could be loaned or a product or service offered on credit. Needless to say, this qualitative approach to knowing about a person's financial standing worked well, but had its own pitfalls, which meant that a wrong assessment can lead to loss for the lender. Eventually, credit bureaus started to offer their services by employing representatives who can do all the legwork involved with collecting information related to a person's creditworthiness. This was still far from the time of automated credit scoring and deep analysis of the reports. It was more of a decision-making process which required the representative to find out if a person was worthy of obtaining a credit or not. The representative would visit different stores and lenders and accumulate data related to the payments and transactions conducted by the person who is being assessed. Representatives were not dealing with exact figures that can help them easily decide whether a person's creditworthiness was good enough for a loan or not. It was found that these early reports to identify creditworthiness was very subjective. It reinforced social hierarchies, and it was very biased, where people end up being marked negatively because of their race, ethnicity and gender. For most part of it, a representative was left with answers like, "He usually pays on time." This could either mean that he is a good customer, or there is a chance that this person may end up defaulting on payments too. It was easy for an enterprise to turn a person down, even though they had good creditworthiness, simply because the manager did not find the person's conduct was not up to the mark. Credit reporting started modernizing by the early 19th century, when business started to grow and people wanted to depend on a better system, where shopkeepers didn't just have to depend on neighbors or acquaintances of the person borrowing the money. This led to different experiments through which lenders can find out the creditworthiness of a person in an impartial way. The most popular of these experiments was conducted by a merchant named Louis Tappan in 1841. The experiment, known as mercantile agency, was started after the grueling phase of 1837, when the markets experienced a depression because of the overextension of credits by merchants. Mercantile agency's rival Bradstreet Company ended up creating a method through which the data collected by the representatives could be translated into actionable facts. Mercantile Agency renamed itself as R.G. Dunn and Company, which came up with an alphanumeric system that could be used to evaluate credit reports. The two companies later merged and came to be known as Dunn and Bradstreet. But most of the credit reporting at this time was limited to commercial businesses only. Consumer credit reporting came into existence in the second half of the 19th century, when credit lines started being offered to the consumers by department stores, the auto industry and other retailers. Retail Credit Company, RCC, founded in 1899 in Atlanta, was one such company that accumulated information about a person through the many activities and transactions they conducted in their lives. It was criticized many times for having accumulated information which was not just about their finances, but also about their social, political and sexual lives. Credit reports based on scoring like this was deemed to be biased, and it could often be judgmental. The world was in need for an unbiased and impartial system of credit scoring which can help people obtain loans without the worry of being judged, not for the creditworthiness but for their character. This led to the creation of an automated scoring system in the 1950s. It was devised by Bill Fair, who was an engineer, and Earl Isaac, who was a mathematician. The system was considered to be a failure when it was first introduced, but its creators did not give up. They continued to improve and refine it using technology and computers till they formed the famed FICO score, which is a popular credit scoring model used by many credit bureaus. Fair and Isaac sold their idea to a number of banks and financial institutions who found it to be very useful to find out the creditworthiness of their clients. FICO was successful because of the availability of technology and computers which brought in a level of ease and eradicated human judgment which was creating partial scores earlier. To further standardize the methods used for credit reports, the government of United States passed the Fair Credit Reporting Act in 1970, which regulated the system of credit scoring and identified various rules related to the amount of time for which the report was valid, how a negative component can affect the score, and for how long can the negative component be taken into consideration. It highly increased the accuracy of data and improved the way in which creditworthiness was being calculated till then. With its dark past, RCC changed its name to Equifax and continued to computerize all the data it had accumulated over the many years of operation, and was soon joined by Experian and Trance, who formed the big three of credit reporting in the United States today. Lesson 1. Credit score in different countries. Every country follows its own rules and regulation related to credit scoring, but many countries have the same organization handling credit information and scoring the creditworthiness of its people. Companies like Equifax, Trance and Experian operate in more than one country. The credit scores also use different ranges depending on the credit scoring model being followed by the Bureau. Australia. Australia's main provider of credit files is Visa Advantage. Retailers and financial institutions in the country use credit scores to assess the creditworthiness of a person. It plays an important role in the country because credit scores can be the reason for the approval or denial of loan. It can also be used for setting credit limits on the credit cards or store cards used by the people. Earlier, Visa Advantage used to provide negative credit information only. This helped companies identify defaulters so that they can avoid paying to people who may not be worthy of the credit. Since March 12, 2014, positive reporting has also been introduced to the country's credit reporting system. This allows lenders to implement risk-based pricing and set lending rates according to the creditworthiness of the person applying for credit. Austria. Austria mainly uses credit scoring to create a list of blacklisted persons. This list is then used by financial institutions, lenders and retailers to identify people who may not be able to pay their loans on time. It can lead to the denial of contracts. The Austrian Data Protection Act plays a pivotal role in the collection of data because data is collected only for those people who have opted in for the collection of data. A person can choose to withhold permission of using the data that has been collected at any point of time, which will then make it illegal for a company to collect further data or distribute data regarding the person to others. Any data that is collected unlawfully must be deleted, and all wrong data should be corrected. People can access details of the data that is being used for their credit scores by requesting a free copy of the data held by the credit bureaus once a year. In addition to the blacklists, Austria also has agencies and credit bureaus who provide credit scoring information and data. Canada. Credit report in Canada is primarily handled by Equifax and Trance. These companies follow the same model for calculating credit scores as in most other countries where they operate, including the United States. However, the Canadian government allows its people to request a credit report any number of times till the time the request is sent in writing to the credit bureau and the report is requested to be sent by mail. When a person requests his or her own copy of credit report, then there it does not affect the credit score. This request is considered as a soft inquiry by the credit bureau. The government also takes a number of measures to keep its people informed on how credit scores are calculated and how they can improve their credit scores. Denmark. In Denmark, credit scores are used by many companies and financial institutions to identify the creditworthiness of a person or a company. The credit scoring for private individuals is mainly done to identify whether a person may default on their payments or not. Businesses are also evaluated for creditworthiness to find out if it may end up bankrupt. Two notable credit bureaus in Denmark are Experian and Bisnode. The information collected by these companies is mainly through the data provided by the applicants and data that is publicly available. Germany. Like many other countries, Germany also uses credit scores to identify if a loan should be approved for a person or not. Similarly, it is also used to find out the credit limit that should be set for a person when he decides to get a credit card or a store card. The main credit bureau in Germany is Schufa, which is responsible for almost 2/3 of the country's credit files. India. The Reserve Bank of India has licensed 4 major credit information organizations to accumulate data and provide credit scores for the people of the country. These 4 organizations are Credit Information Bureau of India Limited, CIBIL, CRIF, Highmark, Equifax and Experian. CIBIL is oldest organization and its scores are deemed to be the most acceptable by lenders. It started its operation in 2000, the rest of the 3 companies received licenses to operate in 2010. A CIBIL score ranges between 300 and 900, where 900 is considered to be the best score. The credit score of an individual is built over a period of 18 to 36 months. A credit history which is less than 6 months old will have a CIBIL score of 0, while people with no credit history at all will show a CIBIL score of -1. Norway. Credit reporting in Norway is based on publicly available information only. This includes data collected through tax returns, taxable income, non-payment records and demography, which is registered for the person who is being assessed. The main agencies who collect credit information and handle credit scoring are Dun & Bradstreet, Lindorff Decision and Experian. South Africa. Credit scores are used extensively in South Africa. Everyone from banks to microlenders and retailers use credit scores to identify the creditworthiness of the consumers. The companies provide negative as well as positive data, which empowers the lenders and retailers to predict the probability of a person paying his loans in a timely manner, and also identifying the credit limit according to the risk appetite of the person who is being assessed. TransUnion, Experian and Compuscan are 3 main credit bureaus of South Africa. Sweden. Sweden's credit scoring system is based on the concept that the government should be able to identify people and businesses who are neglecting bill payments and taxes. All individuals and 5 companies who do not pay their bills on time, even after a reminder, are answerable to the Swedish Enforcement Authority, which is the country's national authority for collecting debts. If a case is forwarded to this authority, then it results in a record which is stored and used for 3 years for an individual and 5 years for a company. If the report is faulty, then it can be disputed by the person, and the person must be able to prove it to be correct. Not being able to prove the dispute will mean that the person accepts the debt, and they will then have to pay for all the costs of the trial. United Kingdom. Credit scoring in the UK is complex. It differs from lender to lender. Lenders are not obliged to reveal information related to credit scoring, like the minimum score for a person to be eligible for the credit. The system of credit scoring is closely regulated by the Information Commissioner's Office, ICO. All complaints related to credit scores can be sent to the ICO or the Financial Ombudsman Service. With the complex system of credit scoring followed in the UK, people find it difficult to predict whether they will be accepted for credit or not. United States. Credit scores in the United States is mainly calculated by the 3 credit score companies, TransUnion, Experian, and Equifax. The credit score of a person is used to identify their creditworthiness, which shows whether a person will be able to repay the loan in a timely manner or not. These companies usually do not take income into account when calculating the credit score of a person. New credit scoring companies have emerged in recent years. These companies look at a different set of factors which affect the creditworthiness of a person. Some lenders have started combining scores from these new companies as well as those from established credit bureaus to identify the creditworthiness of an individual. These are the main countries where credit scores are used by lenders to find out if a person has a high probability of not repaying the loan amount. These credit scores also help in choosing interest rates, the amount of payment a person has to do, and to fix insurance rates and premiums. The financial sector of the economy of these countries rely heavily on the credit reports or assessments done by the credit bureau. It is seen to be beneficial for the person loaning the amount as well as the lender because the credit assessment helps in identifying how much would the person be able to repay, a limit on the credit that the person can avail. Lesson 2. Factors that determine credit score. Countries have different factors that can affect the credit score of a person. Credit score is determined so that lenders like auto dealerships, banks, and credit card companies can find out the amount of money that can be loaned to a person and the interest rate that should be charged. In addition to lender, insurance companies, landlords, and employers in some countries may also check credit reports to find out if a person is financially responsible or not. Depending on the agency calculating the score, there are some differences in calculations, but for most part of it, a credit score is identified by looking into the payment history, the accounts owned by the person, the amount of money he owes, and the length of the credit history. Payment history. Most of the companies that collect information for credit scoring consider payment history to be the most important part of credit scoring. This is because the payment history of a person can usually help in identifying his payment patterns, which in turn helps in understanding the probability of defaulting for future payments. Late payments of bills that show up on your credit account can be the reason why a person's credit score may be slipping down. The more a person delays in paying the bill, the more negatively it affects the person's credit score. This is why timely payments are extremely important in order to maintain a good credit score. If any accounts go into collections, then lenders may see this as a warning that the person may not pay. Other things that negatively affect credit scores in terms of payment history are charge-offs, debt settlements, and bankruptcies. A lender may not be quite comfortable loaning a certain amount to a person who has these red flags in their credit report. Amount a person owes. Another factor that is taken into account is the amount of credit that the person has used from the credit that is available to him. The lower you owe, the better you are scored, but this does not mean that you will be scored well if you owe nothing at all. Lenders prefer people who borrow and who tend to take credits and repay them responsibly. When checking the amount owed by a person, a credit report usually favours those who have a mix of loans like auto loan, credit card and mortgage account. Knowing that a person is handling different loans accounts efficiently makes him score higher. It is important, though, that the overall amount of money owed by a person is lower when compared to the original amount that was loaned out. Length of credit history. The length of time for which a person has been taking credits is another factor that is taken into account. It shows that the person is responsibly repaying all the loans for a long period of time, which boosts his overall score. A long and positive history is helpful for people who are planning to take a new loan. There is a high probability of lenders to lend him the amount he requires at a decent interest rate. But this does not mean that short credit histories are bad. They can be good too till the time you have made your payments in time. New credit. A lender is also interested in knowing how many new credits you have taken recently. This helps him know if you will be in a position to repay the loan in a timely manner or not. People usually open new accounts or apply for new credit cards when there is a problem of cash flow. This is why credit scores check for new credits to identify a person's credit risk. Types of credit in use. Another factor is different types of credits that a person currently owes. Different credit accounts are considered to be better if you are paying on all of them in time. There are revolving loans and installment loans, which are two types of credits that a person can take. Having both types of loans can positively affect credit scores. Credit inquiries. A credit inquiry implies that you have made a credit-based application which has led to the inquiry. While a credit inquiry does not bear a lot of weightage and it does not hurt credit scores terribly, too many inquiries in a short period of time can make a difference. Inquiries affect the score only when it is made by lenders. When a person sends a request to know their own score, then it is considered as a soft inquiry which has no effect on the credit score. People often mistake a number of other factors like income, bank balance, age and marital status to be of importance when applying for credit as well. However, these factors don't play a role, at least not directly in your credit scores. They may affect your ability to pay your loans, but they are not counted in most credit scoring. In many countries, credit scores are assessed with the help of publicly available information only. Some countries have very strict laws regarding data protection, which does not allow lenders to access information about a person till the time the lender has agreed to it. Lesson 3. Popular credit scoring models. The credit scoring system, even till now, remains a largely complex system. The opacity of credit scores makes it difficult for people to understand and sometimes even access it. In most countries, lenders have the option of using their own credit score or a national score to determine the creditworthiness of a person. Users have access to their credit scores either by paying for it or by requesting a free copy, depending on the regulations of the government, but many hardly ever look into their credit scores till the time they are denied credit. In the United States, there are many different credit scoring models, but most of them focus on the same factors with different weightages or slightly different rules. The following are the most popular credit score models used by credit bureaus. First, FICO scoring model. Most lenders rely on the FICO scoring model because it is deemed to be one of the most accurate ways of identifying the creditworthiness of a person. The model has been used by companies since 1989, and it continues to make changes to include or exclude various factors to ensure that the model is relevant to the current age. The last scoring model update was introduced in 2014 with FICO 9. The update reduced the weightage it earlier put on unpaid medical bills. Lenders can choose to continue using the previous model instead of upgrading to the latest one. It depends from lender to lender about which model they are using. Upgrades can be expensive and lenders may choose to stay on the model that they currently have. A FICO score is made up of the following factors: payment history 35%, amounts owed 30%, age of credit history 15%, new credit or inquiries 10%, types of credit 10%. This is not the only way that FICO assesses a person's creditworthiness. There are different models that are used for finding out your creditworthiness for mortgages, auto loans, credit cards and other credit inquiries. However, these factors play a big role, and for a person to ensure that they have a healthy credit report, these things should always be kept in the mind. Second, Vantage score. If there is a credit scoring model that competes neck to neck with FICO, then it is the Vantage score. It continues to make changes just like FICO to ensure that it is accurate and considers current situations of the world in mind. This model has been created by the united efforts of 3 major credit bureaus: Experian, TransUnion and Equifax. This is why it is able to assess 30 million more people than any other credit scoring model. The latest version of this model assesses a person on a scale of 300 to 850. It is known as V3 and it looks at your credit activity for the last 24 months. This model of scoring was introduced in 2006, which makes it very new when compared to FICO, but it gained traction quickly and is used by many credit bureaus now. A Vantage score is made of the following factors: age and type of credit, extreme weight; credit utilization, extreme weight; payment history, high weight; total balances, medium weight; recent behavior, low weight; available credit, extremely low weight. The latest upgrade to the Vantage score model makes it possible for lenders to calculate a credit score within even 1 month of credit history for a person. FICO, on the other hand, needs 6 months of credit history to establish a score. It also does not take into account any accounts under collections if they are less than $250. The score does not count accounts which are affected negatively because of natural disasters. The scale of a Vantage score is also 300 to 850 like FICO. It includes letter grades which vary from A to F in order to help users and lenders understand credit scores in a better way. Third, Trance Risk New Account Score, or simply Trance Risk. This model uses data which is made available from TransUnion. It is used to determine the risk of an individual on new accounts instead of existing accounts. Keeping in mind that it uses data only from TransUnion, and since it is targeted to a limited group which can identify new account risk, the model does not share a lot of details on how risk is assessed. It is yet to get adequate popularity because of its limited nature. Very few lenders use it. Fourth, Experian's National Equivalency Score. Experian uses this model for all its customers to assess their creditworthiness through a number of factors which are similar to those of FICO and Vantage score. Experian is yet to publicly disclose the factors that affect its credit scores and the manner in which users are assessed. Experian's traditional scoring method is very different from those of other credit bureaus. It was designed to be simple and easy for users to understand. Users are scored on a scale of 0 to 1000, where higher scores meant that the probability of defaulting was high. So a score of 900 would mean that there was a high chance that the user may not repay the loan in time. The company also introduced an alternative scoring range, where the users are scored on a scale of 360 to 840. This scoring is similar to the scoring methods used by FICO, and it was designed to resonate with FICO's scoring model, where higher scores meant that the chance of defaulting is low. Fifth, Credit Expert Credit Score. The idea behind Credit Expert's scoring method is to help potential customers get approvals for their credit application. This is why it would look for ways in which a credit could be approved for a new account. It looks for ways in which credit scores can be improved quickly. The company works on the belief that when credit applications are approved, the company is able to build more trustworthy relationships with their clients. Sixth, Seee credit score. Seee score was created by a person who wanted to introduce transparency and accessibility to credit scores. Since people in the United States are eligible for just one free credit report in a year, Seee score provides them with free credit reports at any time. The users are scored on a scale of 330 to 830, and it uses similar factors as FICO and Vantage Score to score the users. Quicken Loans is a sister company which uses Seee scores to assess their customers' creditworthiness. It has gained a substantial amount of popularity in the country because people want to know their scores for free. Seventh, Insurance Score. A person's insurance score is used by insurance companies to identify high-risk customers and to set premium amounts for the insurance. The insurance score is relatively different from a credit score, but credit score are taken into account and are a factor in determining the insurance score. Insurance scores usually range between 200 and 997, but it may vary from company to company. Knowing the factors that determine credit scores can help in ensuring that a person is able to maintain the scores or take steps to improve the scores. Lesson 4. Criticism related to credit score. The system of credit reporting is yet to be a transparent one. It continues to reinforce social hierarchies even till this day, where private and confidential information about a person is held by credit agencies in order to identify how worthy they are of being able to repay their next loan. Lenders all over the world use credit ratings to identify good consumers from defaulters, but the complexities of credit ratings systems and secretive manner in which credit reporting companies work till this day makes it difficult for many people to believe that it is a plausible system. Some of the most popular criticism faced by credit reporting companies regarding credit scores are: First, credit scores can be gamed. People have started noting that credit scores are not always reliable because many consumers are able to trick the system into believing that they have better creditworthiness by employing different means like increasing the limit of a credit card that they have owned for a long time. By increasing the limit on the card, the credit availability of the person increases, and the system that calculates credit sees this as a positive component while assessing a person. This is one of the ways in which a credit report can be gamed. There are other ways in which a person may end up showing a higher score even when they may not be doing well when it comes to their finances. Second, it cannot predict risk effectively. Many financial institutions found that credit ratings were not always dependable. Keeping in mind that lenders would risk huge sums of money based on the credit report, it was found that lenders ended up losing money simply because the credit report showed that the person is eligible for the loan. Some banks, like Golden West Financial, ended up dropping the FICO scores and chose a more expensive method of identifying creditworthiness to ensure that the people it loaned money to would be able to repay the loan. At times, financially secure people who do not use credit cards or have not taken out loans end up being assessed wrongly as people with low credit even though they are in a stronger financial position as others. Users who use many credit cards and have lots of installment loans end up being assessed as someone who is low risk even though they may not be in a position to take more loans or credits. Third, involves access of data to potential employers. Many people do not want their private information to be revealed to others. With credit reports being made available to potential employers, credit reports have been vastly criticized for divulging information to people who should not have access to it. Employers use credit reports to find out if a person is financially sound and will be stable at work or not. While their concern is understandable from their perspective, it reduces privacy. Fourth, allows landlords to scrutinize the creditworthiness of prospective tenants. Another concern that is rising when it comes to credit reports is the fact that landlords can request a credit report to find out if a person is financially secure to pay rent every month. Those who have criticized this explain that employment and tenancy are some basic needs of a person who wants to participate in modern society. These things should not be subject to credit reports. Lesson 5. Importance of credit score for individuals and businesses. No matter how much they are criticized and how less transparent credit scores are, they are an important part of successful money lending. It has helped lenders and consumers understand the limit of lending and borrowing and ensures that both lenders and consumers are able to profit from the credit scores. Helps lenders identify high-risk consumers. The most important part played by a credit score is that of identifying creditworthiness of the consumers for lenders. From having to collect information through relatives to being able to easily find out if a person generally defaults on payments sitting right where they are, credit reporting has come a long way, and in all its modifications it has helped lenders know and understand credit scores in a better way, giving them the ability to identify good-paying customers from defaulters. Gives people ability to understand their credit standing. Very often, a person may end up looking for more credit than what they may be able to repay. By means of credit scores, a financial institution is able to find this out and deny the person further credit. Not only does this save the lender from lending to a prospective defaulter, it also saves the consumer from taking a loan that they may have difficulty repaying. Improves the overall functioning of the lending market. By helping lenders and consumers find out if they are in a position to lend more money to a consumer or to borrow more from a lender, credit scores ensure that the lending part of the financial markets runs smoothly. Conclusion. Credit scores have made it easier for the financial markets to function in a manner where they do not have to depend on word of mouth to identify if a loan should be approved or denied. They are less expensive and do not require a lot of hard work or the employment of too many people to go around and find out about a prospective client. The fact that a lot of the credit reporting industry is still shrouded in mystery, with companies denying access to information about how they assess a person, makes credit reporting somewhat unwanted for people who prefer knowing and understanding how they are being assessed. It has also been found that credit reports can be flawed, and there are ways to trick the system into believing that a person is low risk when he may actually be high risk. This is why credit reporting companies continually evolve their reporting models to incorporate new changes that can be more relevant according to the manner in which finances are perceived at the current time. Many new credit scoring models have been introduced in an attempt to reduce the dependence on scores which are complex and cannot be comprehended by the average consumer. Companies like Seee Credit are focused on making credit scoring simpler and looking for ways in which every consumer is approved when they apply for credit. There are hundreds of credit scoring models followed all over the world, and the same person may end up with different credit scores depending on the model being followed, the company assessing them, and the industry for which they are being assessed. Insurance industries use credit reports in a very different way. Retailers have a different model, and banks require information of a different kind from the credit reports. The same credit reporting company will be able to provide different types of credit reports to various industries for the same person. Many feel that history hasn't changed as much, and credit reports are still mysterious, and they continue to be a thing of social hierarchy where the people from the higher stratum of the society are hardly touched by the concerns of credit scores, while those on the lower stratum face its effects.